Hello and welcome to Financial Flow, where we make accounting simple and easy to understand. Today, we will be breaking down debits and credits. By the end of this video, you will be able to understand and use debits and credits with ease. First things first. Debits and credits are the foundation of accounting. The debits are on the left and the credits are on the right. Debits increase asset and expense accounts such as cash, accounts receivable, supplies, rent, utilities, and wages. They decrease accounts such as accounts payable, notes payable, sales revenue, owner's equity, unearned revenue, and service revenue. Let's visualize that better with an example. Say you own a small business and you recently purchased $500 worth of office supplies using cash. What would this look like? Take a minute to think about the journal entry. You can pause the video now if you would like. To write the correct entry, first identify which accounts are being used. Supplies and cash are both asset accounts with a normal balance of debits. You purchased supplies, so your supply account goes up by $500. And because you used cash to pay for that transaction, your cash account decreases by $500. Pause the video and look over the information if you need to. Did you get it right? Let's try another one to solidify your understanding. Now imagine renting an office space for your business that you pay for on account. How would you record this? Remember that on account means that you will not be using cash as you opt to pay at a later agreed upon date. Pause the video now and think about the journal entry for the office rent. This one was a little more tricky. Rent is an expense account that is increasing. Here you are increasing your expenses by $2,000. Now because you opted not to use cash, your accounts payable account also increases by $2,000 instead of your cash account. How did it go? Did you remember to record it as a payable? Let's now take a look at credits. Credits increase liability and revenue accounts such as interest payable, taxes payable, rent revenue, interest revenue, owner's equity, and retained earnings. Credits decrease accounts such as cash, inventory, equipment, depreciation, dividends, and accounts receivable. Now that you have completed entries for debits, let's try one for credits. You are an owner of a company and you receive a refund in the amount of $400 for an overpaid utility bill. How would you record this entry? Both utilities expense and cash have normal balances of debit. This means that debits increase these accounts and credits decrease them. Cash increases from the refund by $400 while expenses are lowered by $400. I think you can get the hang of it with a little more practice, so let's try one more. Remember that office space you rented? Today is the due date for the payment. How would you go about recording this payment? Here is the solution. When you recorded rent expense earlier, you recorded the payment as an accounts payable. When this payment is due, you must settle the accounts by decreasing cash and decreasing accounts payable. We decrease liabilities, accounts payable, by debiting and decrease assets, cash, by crediting. Let's test your knowledge. If your company receives $5,000 in revenue from sales, how would you record this entry? Drop your answers in the comments below. All right, let's do a quick recap. Debits increase assets and expenses. Credits increase liabilities, revenue, and equity. Every transaction has a debit and a credit to stay balanced. Always double-check that total debits equals total credits. If you found this helpful, hit that like button, subscribe, and turn on notifications so you never miss an accounting tip.